Hey guys, Shelby Mathis here, and today we're going to go over 5 strategies to avoid paying capital gains when you sell real estate. I know that everybody thinks that they're a real estate expert, and there's all these people on the internet talking about how to pay no taxes ever, but here's 5 actual strategies that work under the tax code. They're legal, they're ethical, and I'll go over how they work and how you can get a benefit out of them. Let's go over each one in kind. Number 1. A lot of you guys realize that passive losses can only be used against passive income. Oh, unless you sell the asset, in which case you have suspended passive losses that get released. What does that mean? It means if I have passive losses that I've been carrying forward, and by the way, the form number is 8582. Like if you go pull up your tax return, you're looking for form 8582, suspended losses. Hey, I never got to write that off. I had passive losses from rental properties because I know what cost segregation is and bonus depreciation, and I created these things. Or, hey, it's just not the greatest property, the depreciation's getting and the repairs are more than what I make, and I create a loss every year, and I'm not a real estate professional, or I'm not an active participant in real estate. Then I end up with these passive losses that I carry forward, and they get released when I get rid of that property. That's actually a pretty big thing. So if I have $100,000 of passive loss from like a warehouse that I have or something, and then I sell it, that's $100,000 I can use to offset other income. And it gets released and I get to use it. So you could absolutely avoid payment of the capital gain on that property. And if there's more, get this, you could use it against your wages too. You just have to go through, first we're going to eliminate the capital gains on the property. Then it's just an ordinary non-passive loss that we can use, period. So that's number 1. Is a lot of times people don't realize that they're carrying these things forward. Their accountant never sits them down and says, hey, we had passive loss every year we're not telling you about. I see it when I review returns all the time. I'm like, hey, you got like $25,000, $30,000 of suspended losses. Sometimes it's $300,000 to $500,000 of suspended losses. And they're like, what's that? You're like, it's a gold mine waiting to happen. Here's how you release those. And or we just use it against something else, which we'll talk about in a second. Actually, I'll just talk about it right now because I don't want to make you wait. You can use passive losses against any passive income. So even if you have a pizza shop in which you're a silent owner in, and it's kicking out profits, it can avoid it. But our topic today really is the capital gains on the sale of the asset. So we would use it first against that. But of course, if you have suspended losses carrying forward, guys like me love that stuff because we're saying here's some other things you could do to not pay tax. All right, number 2, 121 exclusion. A lot of you guys have heard of this. This is for a house that you lived in 2 out of 4 years as your primary residence. The amount is, if you are single, it's $250,000 of capital gains that you don't have to pay tax on. It's just complete exclusion. $500,000 if you are married filing jointly. So what does that mean? It means, let's say that I bought a house with my spouse 5 years ago. I lived in it for 5 years. I bought it for $300,000 and now it's worth $500,000. I live in a hot market. It's gone up $200,000. I turn around and sell that, and my capital gains, let's just say easy math, is $200,000. I don't have to pay tax on that. I have $250,000 if I'm single, or if you're $500,000 if you're married, of capital gain exclusion. So I would not have to pay tax on that $200,000 of gain. Some of you guys are like, but I sold it for $500,000. We don't pay tax on our basis, the money that we spent, that we bought it with. We only pay tax on the gain. Now there's recapture on investment property. It doesn't offset that. But where a 121 exclusion really gets interesting is when you turn your house into a rental. And what we'll see is people, let's use that same example. I bought a house, I lived in it for 5 years. Then I bought another house. But I didn't sell my old house, I put it in and made it into a rental. If you aren't careful, you have now, let's just do the math, 2 out of 5 years, not the last 2 out of 5 years or last 2 years, It's the 24 months of the last 60. So if I've been living it for 5 years, that means that I have 3 years. So 2 out of 5 means I could use it as a rental for 3 years before I eliminate my ability to use the 121 exclusion. The good part is the code says I don't have to worry about the recapture on any of that either. I can avoid the gain entirely if I am doing the 121 exclusion. So I could take a house, or actually I would get the entirety of the capital gain. I'd still have recapture, but I would get the entirety of the capital gain. Plus, if I turned it into an investment property, I could actually 1031 exchange it and avoid tax on the recapture. But let's just say that I have a house, same scenario I just gave you, bought it for $300,000, now it's worth $500,000, and I make it into a rental for 2 years. It's coming on the 3rd year, and now I could sell it for, let's say, $700,000. Oh my gosh. So I bought it for 3. I have $400,000 of capital gain that I'm sitting on. What could I do? I could literally sell it as a 121 exclusion, avoid all the capital gain. I could 1031 exchange it as well if I want to and avoid all the recapture, so long as I buy real estate of $700,000 or greater value, and I could buy multiple properties. So I can do that. It's kind of crazy, but I could avoid all the capital gains in that scenario. Let's say that you live in a state like California. Let's say you live in San Francisco and you bought a house for $500,000 20 years ago. Now it's worth $2.5 million, right? And you're looking at, you could actually use this strategy, turn it into a rental property before you sell it. You could use your $500,000 exclusion if you're married, and you could avoid all the gain and the capital gains and the recapture by doing a 1031 exchange. Yes, you can do both. And then you're saying, but shoot, what if I want to buy a replacement house? Well, you're going to have to do this with a tax advisor, but there's a way to do it to where you turn a property into a rental property, then you buy a rental property and turn it into a primary residence. So yes, you can do it. It's going to take a little elbow grease, but it might save you. In that case, if we had we had $2 million of gain, you're talking about $600,000-$700,000 of tax savings. So yeah, maybe it's worth a little bit of elbow grease. All right, number 3, 1031 exchange. So we already put it up here, and it's going to live in conjunction. 1031 exchange is when you sell real estate and you buy real estate of equal or greater value. Now, the beautiful part about a 1031 exchange is that it allows you to avoid capital gains, but it also allows you to avoid recapture. So when you depreciate a property and you sell it, there's something called recapture. You're supposed to pay tax up to 25% on it, depending on the type of recapture it is. If you're doing a cost seg study, it could even be higher, potentially up to your top tax bracket, up to 37%. So a 1031 exchange is a way to avoid that completely. And you are selling real estate and buying real estate. So if it's U.S. real estate, it just has to be U.S. real estate. If it's foreign real estate, it just has to stay foreign. They call it like-kind exchange. But you can go any real estate to any real estate. So if I sell a property for $2.5 million, I can buy $2.5 million of single-family residences, of land, of apartments. I can do a combo. I do a condo, a single family, and a duplex. As long as it all adds up to $2.5 million, I would pay no tax. If it adds up to less, there might be some tax. It's going to be proportionate. But I can use a 1031 exchange in real estate to avoid taxes in their entirety when I sell real estate. That's why people love them. Number 4, cost seg. And I'm just going to put bonus. That little dep means depreciation. Why is that sitting up there? You're like, Toby, how is that going to save me on capital gains? Well, here's the reason. Anytime you have passive loss, it will offset passive income. When you sell a property that was passive, so if I sell rental property and it was passive, then that capital gain is actually considered passive capital gain. So let's say, same scenario, I buy a house at $500,000. I sell it for $1 million. There's $500,000 of gain. A little bit of recapture. But let's just say that there's, for our purposes, it's just there's $500,000 of capital gain. And I have a, let's just say that I have other real estate. One of those pieces of property, let's just say it's a warehouse. I could cost seg the warehouse and create a $500,000 of passive loss. Let's just use that as an example. Say it's a couple $1 million piece of a warehouse or self-storage or a 8-plex or whatever it is. And I do a cost seg on it, and I'll explain what that is in a second. And I accelerate some of that depreciation, and I create a $500,000 loss. I could use that $500,000 loss against my passive capital gains from the sale and eliminate the capital gains on that sale. Yes, you can actually do that. We actually call it the lazy man's 1031. When I sell property and I'm like, crap, I didn't do a 1031 exchange. Now what am I going to do? I have all this capital gain. Well, buy other property and accelerate the depreciation to create a loss that then you could use against your passive capital gains from that particular year. It actually works like a charm. Now, what's a cost seg? Cost seg is when I take a piece of property and break it into its components that are 5-year, 7-year, 15-year property, and 27.5 if it's residential, or 39-year if it's non-residential. So a lot of you guys only know of the 27.5 or 39 years. But there's actually 5, 7, and 15-year if you get a cost seg study done on your property and break it down into its components. So for example, things like flooring, window coverings, things, appliances, the electric that attaches to the appliance, the plumbing that attaches to the appliance, even the cement stand that it sits on, all of that takes the useful life of the appliance, which is 5 years. So let's say that I walk into a rental property and I start, wow, this isn't all 27.5 year property. No, the carpet's not 27.5 year. I should be able to write that off over 5. Go outside, there's a driveway and a walkway. Those are land improvements. Those are 15-year property. How about the trees and the shrubs and the pitch that we put in and the fence around there? That's all land improvement. That's 15-year property. I can write that off faster. Plus, depending on the year that I put it in service, right now I could write off, if I did it this particular year in 2024, we're towards the end, I could write off 60% of whatever that amount is right away. If I bought it in 2022, 23, 21 or 20 or 19 and I put it into service, that property, and I do the cost seg now, I can write off 100% of whatever that property is that's 5, 7, or 15 year. I know some of you guys, there's whole videos that I did on the #1 tax loophole in real estate, and that's cost seg. You can go do a deep dive. What it does is it creates a large deduction in this particular year. Now I can use that large deduction to offset other income I have, including capital gains from the sale of other passive assets. So if you've sold investment real estate, it's passive, and you want to avoid the tax on those capital gains, sometimes it's as easy as taking some of your other properties, and I've done this on multiple years, where I've grabbed an apartment building or one of our warehouses, and I do a cost seg study on it, and it allows me to wipe out the capital gain on some of the sales of assets that we sold. So I sell a property, and then I look around and say, is there anything I can cost seg? If you don't have anything, then buy something you can cost seg. So long as that same year, you can create that passive loss for that particular year and offset the passive capital gain you have from the sale that occurred that year. Works like a charm. Last one, and this is, depending on your situation, this could eliminate, make sure that I did this right, installment sale. Installment sales are anytime you take payment on the sale of an asset over more than one taxable year. So if I say pay me 50% now and 50% in January 15th, then I would have half of the sale in this particular year and half of the sale next year. If I carry back the note for, let's say, 10 years, I could literally spread out my capital gains over those 10 years. Now, your recapture, if you're an investor and you sell investment properties, your recapture is due the year that you sell, no matter what. But my installment sale is going to allow me to recapture basically three things, or capture or pay tax on three things over time. Number one is the return at basis, which is tax-free. Number two, I'm going to get my capital gain, which is going to be taxed at 0, 15, or 20%. So the reason I said it could eliminate your capital gains is if you're retired, for example, you're married filing jointly, and your total income after your standard deduction is less than $94,000, your capital gains, your long-term capital gains that are part of that, are at 0. So you could literally, depending on what your situation is, be receiving, let's just say $10, $15, $20, $30, $40, $50,000 a year tax-free because you chose to do an installment sale as opposed to paying tax on it all right away. Now you get a third type of income. So you have the return at basis, you have your capital gains, and then number three is you have some interest that you're going to have to pay tax on. So they're going to have to pay you interest, but that would be normal taxable income, but you're getting interest, which is great. It's just like a savings account. You're getting it on the sale of your property, but boy, that could actually work out great. What I've seen it do for people is folks that would have been in the highest brackets when they sold and they were like, oh shoot, I'm going to be at 20% plus. This stinkolas, I'd like to not be in 20%. I'd rather be in the 15 or 0. It allows you to stretch it out so that instead of making, let's say, $500,000 all in 1 year, now you're making $50,000 plus a little interest in every year over 10 years. And it might put you in a situation where you're paying 0 capital gains on that as a result. And so all these things, when you're looking at it, they make sense. They're there. How would they apply to you? If you want to see how it would apply to you, you can always reach out to us. We'll do a free consultation. All you have to do is click the link that I'm going to put in the show notes, or you could just write strategy into the comment section and we'll send you a link where you could schedule a free consultation to see whether any of these apply to you. So if you're thinking about selling real estate, the time to do that analysis is before you sell it. If you've already sold real estate and you're like, oh shoot, is there anything I could do? Some of these could still come to your rescue. But it all starts with reaching out and having somebody who knows what they're doing actually look at your scenario, and we'll do that for you absolutely free if you want to take advantage of that. Again, type in strategy down in the comments or use the link that's in the show notes. Hey, if you like this type of information, please like and subscribe. If there's one you think I missed, let me know by putting it in the comment section. I'm not omnipotent. I make mistakes too. I miss things. And if you think that there's another strategy that I messed up on or I didn't include, put it down there and I can make sure that I fix it for next time. And if you know anybody who sells real estate or is an investment or a real estate investor that could benefit from this type of information, please share it with them.